Hi, welcome to Christensen Wealth Management. I'm Michael Christensen. Thank you for taking time out of your day to watch this weekly stock market update for the week ending Friday, January 4th, 2018. Happy New Year. Hope you had a great holiday season and New Year's Eve and New Year's Day. But back to reality. We had a very volatile stock market on January 2nd this week, and then the floor fell out once again on the 3rd of January. So hopefully for long-term buy and hold investors, this is not the sign of things to come for 2019. But if you have watched this video long enough, we do not believe that buy and hold investing is the appropriate course of action for investors or in this environment at all. So with that being said, the Dow was down 600 points again today on Thursday. And there's a whole bunch of reasons for that. But before I get into the commentary, I'd like to read a passage from my favorite book, not one of my favorite books anyway, Riding the Bear by Cy Harding. This particular book was, I decided was one of the best, if not probably the best financial book of all time when I read it early last year. And Cy Harding once said, "The profile of a bear. The first leg down has typically been the result of some investors, usually beginning with professionals and institutions, already nervous about the overvaluation levels of stocks, noticing some deteriorating condition in surrounding economic conditions. They begin to become concerned about the market's ability to make further gains for a while. At each dip, like we had in January of 2018, more investors are willing to take some profits, deepening the dips. The Dow and S&P lost about 10% in January and February 2018, whereas the rallies created when bargain hunters do buy the dips are met by an increasing number of investors willing to immediately sell into the strength each time, causing the rally attempts to fail. We had a few of those in March and April last year. The repeated whipsaws cause those who are buying the dips to wait for lower lows each time before being convinced it's time to buy. The resulting bearish pattern of lower lows and lower highs convinces still more participants that the market is topping out, the selling increases, and a significant decline gets underway. The resulting first leg, which was early in 2018, in my opinion, works off some of the excesses. Wall Street insists that the sell-off has been overdone, that stocks are a bargain, even though they're still selling at levels of significant overvaluation to their fundamental fair value. A rally begins, like we had last April, May, June, July, August, September. This rally lasts for several months, convincing investors that all is well, and they scramble to become fully invested again. Basically, that's about the last day of September 2018. The second leg down usually begins when it becomes clear that the problems that caused the first leg down, rising inflation or falling earnings or whatever, were real and not short-term. Corporations begin to report declining sales and earnings, or the economic numbers show the economy is slowing dramatically. Since the problems are now more obvious and widely recognized, the second leg down, which is October 2018, brings in more sellers, so reaches a much lower low before becoming short-term oversold. A condition that is followed by yet another bear market rally, like we had in November and December. We had several bear market rallies. In fact, the day after Christmas, the Dow went up 1,000 points, the greatest point gain ever in a single day for the Dow Jones Industrial Average. Now, the final leg down begins when that rally also fails. When the market rolls over this time, which we may be seeing right now because the Christmas post-Christmas rally appears to be failing. So the final leg down begins when this rally also fails. When the market rolls over this time, investors begin to panic at the resumption of their losses and the growing gloom and doom in the financial news. The final panic leg down washes out all of the previous excesses and interest in speculative investing and carries valuation levels all the way down into undervalued territory, the exact opposite of the overvaluation levels at the bull market peak, which we had in September and October last year. At that point, the buying opportunity of the next 10 years is presenting itself. Unfortunately, this is what you really need to know. By then, buy and hold investors, which include the majority of public investors, have bailed out with huge losses and have no interest in the market. Only corporate insiders, institutions, and professionals who are definitely not buy and hold investors, as we shall see later, tending to sell near the bull market top, have the cash, the interest, and the confidence to load up on the bargains at the bear market low. So yet another cycle begins. So people have been saying to me lately, how can this be a bear market? Haven't you seen the fundamentals? What about the fundamentals? That is an interesting question, because the thing that you often need to know is that at bull market highs, economic data is exceptionally good. At bear market lows, economic data is exceptionally bad. So it makes sense that when the bull market starts to top out and begins to fall, and in this case, we've been in a bull market for 10 years, well, usually at the top of a bull market, economic data is great. So it is not surprising that people would say, why would the stock market go lower? Haven't you seen the fundamentals? Well, today, some economic information came out that I'd like to share with you. Let's take a look. What you see here is a chart of the Institute of Supply Management Manufacturing Index and the Market Economics U.S. Manufacturing PMI, or Purchasing Managers Index. And as I was just saying, if the fundamentals are strong, they should be rising. And this particular chart, the Institute of Supply Management Manufacturing PMI in blue, is in fact defined as a survey of more than 300 manufacturing firms by the Institute for Supply Management. And it monitors employment, production, inventories, new orders, and supplier deliveries. When that index is rising, the fundamentals of the economy are strengthening. And when it is falling, the fundamentals of the economy are falling. So let's see what it is doing right now. You can see by this chart that the blue line, the Institute of Supply Management Index, is falling rapidly. In fact, before I get too far here, I want to talk about the green line, the Market Economics U.S. Manufacturing PMI, which Market Economics is a leading global diversified provider of financial information services with 3,000 employees in 11 countries. Their job is to track economic data as well. Well, this chart shows that the Purchasing Managers Index, which is also an industrial and economic metric, is also in decline and has been slowly fading since about March of 2018. So today, an article came out on Zero Hedge that said that yesterday, when market reported that the U.S. manufacturing PMI tumbled to a 15-month low, we were wondering how much longer the other PMI can continue to defy gravity. Well, the answer, it turns out, was about 24 hours, because moments ago, the Institute for Supply Management reported that the December ISM plunged from 59.3 to 54.1, precisely where the PMI print suggested it should, which was the lowest print in the Institute of Supply Management survey series since November of 2016. And it was also the biggest one-month drop going back to the financial crisis, when in October 2008 it dropped by 9 points. So you can see from that chart that some economic fundamentals are not rising. Some are falling, and those are very important fundamentals to pay attention to. Those two indexes are a very key element of economic data. And with those two falling as much as they are, it is time to pay attention. It has been 10 years since the last recession and bear market, and we are due for one. And I always like to say that if the stock market isn't going in the direction you want it to, own something else. It's not the only investment choice out there. There are lots of asset classes that you can put your hard-earned retirement savings in and try to make the best of a bear market. Bear markets do not need to be your enemy. They can be your friend if you just know how to deal with it. So with that, I'd like to say that I'm going to do another video here that you can watch with the chart recap. I don't want this video to be 20 minutes long, so if you want to watch my charts, go to the next one. I really wanted to bring you that page from Cy Harding's Riding the Bear. I felt some context and history from 1998, just before the big dot-com crash, was important to share with you, and I hope you got something out of it. See you again in about another 7 days, and before you go, please do me a favor and click the subscribe button on the YouTube channel and click the little bell next to it so you'll be notified whenever additional videos are posted. And in the summary description of the video, you will find links to the Christensen Wealth Management social media pages. Thanks again. Have a good day. Bye-bye.